Welcome back to the deep dive. Today we're tackling something huge in Australian property. That big question. Renovate or buy ready-made?
It's the question, isn't it? Is it still worth the blood, sweat, and frankly, the massive cost of doing up a place?
Or is the smart money now just saying, look, I'll pay the premium, just give me the keys?
Exactly, and that's our mission today. We're digging into market data right across Australia up to August 2025,
Right.
trying to find where the profit actually is, if anywhere, and understand why, convenience is suddenly king.
Okay, let's start where most people do. You love your street, the schools are great. Renovating seems like the obvious way to avoid moving costs,
Oh,
right?
absolutely. Those costs are brutal.
Yeah.
Think about South Australia. Minimum 5% of the property value just in transaction fees. Gone.
Ouch. Yeah.
So yeah, staying put and changing the house to fit your needs, getting that dream floor plan, it makes a lot of sense on paper. Avoiding disruption.
But then you hit the financial wall, the cost. Let's talk about construction costs, because that's the elephant in the room.
Well, there's sort of good news and bad news. ABS data to March 2025 shows the rate of increase has slowed right down, only 1.1% annually.
Okay, 1.1%. That sounds manageable. Trades are easier to get now, too, apparently.
Easier, yes, but that 1.1%, it's a bit misleading, I think. It just means the crazy price explosion stopped. We're still starting from a much, much higher cost base than, say, 5 years ago.
Right. So doing a kitchen or bathroom today, it's still way more expensive.
Dramatically more expensive, no question.
So why then? Why are buyers paying even more for a house that's already done? If the reno cost base is high, surely the finished product reflects that plus a profit margin.
Because they're not just paying for materials and labor. They're buying certainty.
Certainty. Okay.
They're paying to avoid the stress, the time off work,
Yeah.
the budget blowouts, the dodgy tradies, the material delays, all that chaos,
Yeah.
that peace of mind. That's what the premium is for. It's risk mitigation.
And people are really valuing that risk mitigation. I mean, look at the spending in Sydney.
It's huge. Greater Sydney saw renovation spending hit, $3.01 billion just up to May for fiscal year 25,
Yeah, already more than the entire previous financial year.
which was $2.83 billion.
Yeah.
So massive activity.
But we need to be clear on terms here, right? Renovation versus extension.
Good point. Yeah, the sources distinguish this. Renovation is improving what's already there inside the existing walls. New kitchen, new bathroom, paint, floors.
Okay.
And extension actually makes the house bigger, expands the footprint. And getting finance for those two things, very different. Banks see extensions as much riskier,
Right. Simpler to get a loan for an internal facelift than adding a whole new wing.
pretty much.
So, okay. High cost, buyers want certainty. If you are going to do a major renovation, how do you actually make money? Is there a secret sauce?
There is a strategy that seems to work, particularly at the higher end. It's not just about spending. It's about being clever with the existing space.
Oh.
Adding bedrooms and bathrooms.
Mhm.
But crucially, doing it by reconfiguring the current layout, not necessarily extending. That bumps the property into a whole different value category.
Yeah. Okay. Like that Glen Haven example you mentioned, 32 Glenshee Place.
Well, exactly. That's the poster child.
Mhm.
Bought for $2.71 million.
Right. And they did a full internal and external job.
They did. And they were smart. They took old formal rooms, the separate dining, the lounge nobody uses, and turned them into a massive new main bedroom suite, plus another en-suite.
So they didn't make the house bigger, just repurpose the space.
Correct. Went from a 5-bed, 4-bath,
Correct.
6-bedroom, 6-bathroom luxury home,
Wow. And the result, 11 months later.
sold for $4.4 million.
Get out. That's what, $1.69 million more?
A 62% uplift. That's strategic renovation paying off big time.
Okay, hang on. A $1.69 million profit. Surely that relies heavily on the whole market rising during those 11 months. That feels like a big gamble, especially at the top end.
It is a gamble. Absolutely. And that's the catch. You have to know your market. Glen Haven supports that kind of large luxury home. Try that same renovation in a suburb where people want smaller, more affordable places.
Disaster. You'd overcapitalize massively.
Completely. You need recent sales evidence that proves buyers in that specific spot will pay top dollar for what you're creating.
So that desire for certainty is pushing things in interesting directions, even huge rebuilds, like that place on the lower North Shore, 56 Warren Road.
North Willoughby, yeah.
Yeah.
They knocked down the original house entirely.
And built 2 high-end duplexes instead.
Exactly. And one side sold for $5.751 million. That tells you established families, downsizers. They want the premium features, lifts, pools, basement parking, and they want it done. No construction headaches.
They'll pay almost $6 million to avoid the build risk themselves. Incredible.
The premium for certainty.
Okay, that works at the luxury end, clearly. But what about the rest of us? Mid-market, Southwest Sydney, for instance, the margins must get squeezed there?
Squeeze is an understatement.
Yeah.
Yeah, this is where it gets really tough for the average person trying to flip or add value.
So take Eschel Park. The analysis there showed.
Right, they compared similar three-bedders, one renovated, one not. The difference in sale price, only $133,500.
Oof. Once you take out renovation costs, holding costs, your time, your stress, is that even worth it?
It's discouraging, isn't it? Hard to see the profit margin justifying the risk and effort there.
And it gets even worse in the inner city, right? Places like Paddington, Redfern, traditionally prime flipping territory.
Used to be. But the high prices now mean your holding costs are enormous. Interest rates, land tax, while the property's empty being renovated.
That Paddington example was telling. 155 Paddington Street. They made a gain on paper, sure.
But the source pointed out that the median price in Paddington went up by about 53% in the same time it took to renovate that place.
So the market itself did most of the heavy lifting?
Pretty much. And think about it. If the market's rising that fast, your bleeding cash on holding costs, maybe six figures, just vanishes before you even factor in the Reno budget.
So that paper profit, it gets eaten up really fast. You need a truly huge value add just to beat passively holding the property.
Exactly. Very difficult in those expensive, fast-moving markets.
So if big structural changes are risky and expensive, where's the safe bet? What does work reliably for the everyday renovator?
Cosmetics. It always comes back to cosmetics.
Okay.
The analysis consistently shows quick, high-impact updates still offer great bang for your buck, maximizing sale price or boosting rent.
We're talking paint, new carpet.
Yeah, fresh paint, new floor coverings, maybe update the taps, new toilet cisterns, maybe a quick, relatively inexpensive kitchen or bathroom refresh if needed. Nothing too structural.
Basically, make it look clean, modern, and move-in ready without breaking the bank or the walls, like that Warrywood place, 41 Callistamon Way.
Perfect example. Simple cosmetic stuff, shutters, floors, kitchen refresh. Led to a decent, solid uplift. Not spectacular like Glenhaven, but profitable.
Right. And don't forget the rental angle.
Absolutely critical point. Renovating purely for rental return is a different game. Especially in super tight markets. Think Darwin 0.3% vacancy rate.
Wow, 0.3%. Basically nothing available.
Or somewhere like Lismore, sadly, post-floods. You can potentially buy low, renovate for durability and rental appeal, get great rent, and claim depreciation. It shifts the focus from capital gain to cash flow.
A totally different strategy. Okay, let's look beyond the East Coast bubble. Regional markets play by their own rules. What unique opportunities are out there?
Well, Western Australia is booming. Perth especially. Strong growth, not enough houses. So renovation looks pretty attractive there.
Any examples jump out?
Ferndale, a 1970s place. Bought for $545K, full internal-external Reno. Sold less than a year later for $850K.
Nice. That's around a 50% jump. Much lower entry price than Sydney, too.
Definitely. Then you look at Melbourne, and it's like two different cities.
How so?
Inner Fringe Collingwood. South Yarra buyers want the unrenovated character homes. They'll pay for the land and location and take on the project themselves.
Because it's all about the address.
Precisely. But head out west. Tarnite, Melton. Totally different story. Buyers there overwhelmingly prefer brand new homes. They want the convenience, the builder warranty, modern designs. Older stock is harder to shift.
Fascinating contrast. What about up north? Darwin sounds unique.
Darwin's got its own set of challenges for sure. Materials are expensive because it's remote, there's a shortage of trades, and the wet season basically shuts down building for 3 months.
9 months a year to get anything done, that's tough.
It is. So the smart renovation there,
Local trick?
elevated homes. Most houses are built high off the ground. The popular Reno is to build in underneath at a self-contained granny flat.
Adds versatility and income potential.
Huge income potential. You can rent that granny flat out for maybe $300 a week, sometimes more, leveraging those really high Darwin rents. It makes financial sense.
Clever. And for the real hands-on types, the dedicated flippers, where can they still make decent money?
You need to look at the more affordable regions. Rockhampton came up as a good example.
Okay.
If you can do the work yourself, the margins are still there. One example, 7 Kirkillen Street. Bought for $320K.
Right.
Put about $90 into it, mostly cosmetic stuff, paint, fencing, kitchen update. Sold 6 months later, gross profit, $117,000.
Wow. But the key is, did the work yourself.
Absolutely essential. That profit disappears fast if you're paying trade rates for everything. That model relies almost entirely on your own skills and sweat equity.
Which contrasts completely with, say, the Shoalhaven Coast.
Totally. Down there, everyone knows how hard it is to get materials and find good tradies.
Hmm.
So buyers are actually willing to pay a big premium for a place that's already beautifully renovated.
Because they don't want the hassle.
They just want to move in and enjoy the coastal lifestyle. Nothing left to do is the ultimate selling point. Convenience, again?
Okay, let's pull all this together. What's the essential advice for you, our listener, navigating this tricky market? Seems like two main paths to profit emerge.
Yeah, I think so. Path one is what we could call long-term lifestyle. This works best for owner-occupiers, people staying put.
Right.
You renovate primarily for your own enjoyment to make the house work better for your family. You plan to stay for, say, 5, 7, maybe 10 years.
And over that time, the market hopefully rises enough to cover those high initial reno costs.
Exactly. Market growth becomes your friend. Time smooths out the bumps.
Okay, path one, renovate for lifestyle, stay long term. What's path two?
Path two, short-term flipping. This is much harder now, but still possible if you tick specific boxes.
Which are?
Two crucial things. One, you must buy the property well below market value. Often off-market deals are the only way. You need built-in equity from day one.
Okay, buy cheap. What's number two?
You need the skills to do most of the work yourself or have very cheap or reliable access to trades. You have to minimize those labor costs.
And focus the work where?
High-impact cosmetics, things that appeal to the widest range of buyers. Keep it neutral. Keep it clean. Avoid anything too personal or out there that might put people off.
Right. And for anyone attempting either path, especially a bigger project, that fear of overcapitalizing is real. Any safety nets?
The simplest one. Get a valuation before you start. Talk to a professional valuer. Ask them, if I do exactly this work, what will this property likely be worth at the end?
Do the sums up front.
Do the sums up front. Don't rely on guesswork or hope halfway through when the bills are piling up.
Makes sense. And despite the cost, we keep coming back to it. Kitchens and bathrooms.
They just are. They're the money zones. Yes, they're expensive to do well, but buyers notice them first, and they hate the idea of having to redo them immediately after moving in.
So updated kitchens and bathrooms and adding extra ones where possible, like in Glenhaven, that's still the key to unlocking value.
It really signals a move-in ready home, removing a major headache for the buyer. That hassle-free experience is what they'll pay for.
What a fascinating deep dive. Costs, risks, strategies all across the country. It's clear the market has shifted. Renovated homes definitely get a premium.
Yep.
But actually making a profit from the renovation itself, much tougher now because of those construction costs. Unless you're a skilled DIYer or you're playing that high-stakes game at the luxury end, reconfiguring space like we saw.
The risk has been priced into the finished product now, you could say.
So that leads us to our final thought for you to ponder. Given today's market, where turnkey homes command such a high price, what's actually the bigger risk for the average homeowner? Is it overcapitalizing on a big renovation you try to manage yourself with all the potential cost blowouts and stress?
Or is it paying that significant premium for a finished home, knowing that someone else has already absorbed all that risk, time, and hidden cost for you?
Which risk feels greater to you right now? Something to think about. We'll catch you on the next Deep Dive.